Welcome to the deep dive. This is the space where we really try to tackle these complex stacks of global research.
Yeah, cutting through the noise.
Exactly. To deliver those essential nuggets of knowledge, you need to be, well, truly well informed. Our mission today, it's pretty laser focused. We are shifting our attention maybe away from the typical Western headlines, Bitcoin ETFs, Fed
Not
policy.
usual stuff.
Right. And we're going to examine these fascinating and honestly often contradictory capital flows happening across the Asian crypto markets.
And it's more than just like a shift of focus. It's really a crucial analytical exercise, I think. Most global investors, they tend to view crypto through this monolithic lens, right? Assuming market drivers are just uniform everywhere. But the reality is the narratives dominating the US and the EU, they often completely obscure these specific regional tectonic shifts. And that's where the real world, utility-driven crypto adoption and, frankly, significant profit and loss is actually happening.
Exactly. And to really prove this divergence, we've got two completely contrasting, really compelling case studies lined up. We're going to analyze why one asset, XRP, is absolutely surging in Thailand. I mean, reflecting massive local confidence, institutional adoption, driven by actual utility.
Yeah.
And then we're immediately juxtaposing that performance with another major infrastructure asset, Filecoin, or FIL, which is currently facing these heavy, concentrated sell-offs. And they seem driven primarily by key traders located in, well, the major regional hub of Shanghai.
So it's a story of success versus struggle.
Totally. Driven not by the global macro environment, which is what we usually talk about, but by intensely local dynamics, all within the same continent, too.
Which makes it fascinating.
Right. But okay, before we dive into how Thailand managed to turn XRP into, a top-performing regional asset and maybe why these Shanghai traders are dumping FIL, we need to quickly deliver a critical message. Engaging with this deep dive, liking, subscribing, leaving a comment, it really does help support the channel.
It absolutely does. Boosts visibility in the algorithm.
Yeah, and it lets us keep creating this quality crypto content, drilling down into these complex global stories that hopefully matter most to you, takes just a second. And it ensures we can keep doing this level of analysis.
Please do. It helps a lot.
Okay, let's unpack this then. Starting with that core idea, market divergence itself, and maybe why it's so easy to miss in the first place.
Well, the initial problem, I think, for most global investors is really their assumption that crypto operates as this single, globally uniform asset class. They apply a sort of centralized analytical framework, right? If a headline hits the U.S. financial media, they expect, boom, a uniform reaction everywhere else.
Yeah, that makes sense, given it's digital.
It's understandable, yeah, given the digital nature of the assets. But it's fundamentally flawed when you're dealing with altcoins and these regional flows.
Right. We're sort of trained to think that if the SEC makes a ruling or, some large U.S. bank announces adoption, the ripple effect is global, instantaneous. But what we miss, I think, is that genuine sustained market momentum, especially outside of maybe Bitcoin and Ethereum. It often requires this hyper-localized stuff, like regulatory clarity, established regional partnerships, acceptance within local payment rails.
Precisely. The reality is the market is deeply fragmented, primarily along geographical lines and regulatory lines, too. Regional markets can absolutely dictate asset momentum and price action in ways that, major global players sitting in London or New York, they often miss it entirely.
So you really can't understand this divergence without factoring in things like local capital controls.
Exactly. Capital controls, geopolitical alignments, even differing cultural attitudes toward risk and technology adoption, it all plays a part.
So, okay, we have this perfect, almost textbook example right now playing out. Thailand is actively fostering an environment that seems pretty conducive to specific crypto adoption. And in that market, XRP has just outperformed all its major competitors.
Yeah, significantly.
Which seems to reflect this institutional confidence that's rooted in utility, not just hype.
Right. And that stands in really sharp contrast to the regulatory climate over in mainland China, where, capital controls are strict, policy shifts can be swift, often opaque. And these factors contribute directly to that heavy selling pressure we're seeing from Shanghai traders on Filecoin.
So that difference in environment creates the core conflict we're looking at. This regional sentiment divergence is like a live, immediate force.
It really is. On one side, you've got XRP leveraging favorable, localized institutional partnerships, specific regulatory frameworks for cross-border payments.
Yeah.
And on the other side, FIL is facing challenges tied directly to, well, the patience of its localized investor base, plus the structural pressures of its tokenomics, all within a much less permissive regulatory environment.
I find that point so critical, localized policy having a stronger market impact than maybe the big global macro news.
Right.
A lot of Western investors might just assume an altcoin's performance is, I don't know, entirely dependent on what Bitcoin's doing that day.
Right, the Bitcoin beta trap.
Exactly. But for the global investor, if you fail to track this specific regional demand or, the concentrated lack of demand, it means you're operating on fundamentally incomplete information. You're basically trading on speculation, not on actual utility traction.
Absolutely. And the stark difference here, it's a powerful reminder that what pumps in one market, maybe because of clear regulatory utility, might actually dump in another because of structural tokenomics pressure. That's the central lesson.
Okay.
These regional narratives driven by local policy or, localized utility adoption, they are often far stronger predictors of an altcoin's success than just the macro noise that dominates the global financial news feeds.
So we need to look beyond the Bitcoin charts.
Definitely. And ask where the genuine utility testing grounds are actually emerging. And right now, Asia is where that testing is happening at scale.
Okay, here's where it gets really interesting, I think, moving into this success story. Why Thailand? Specifically, why are they so bullish on XRP? Our sources are pretty clear. This isn't just like retail hype or some short-term speculation.
No, not at all.
It seems fundamentally rooted in tangible, real-world utility, centered around cross-border remittances.
It's entirely strategic, and it really starts with geography and economics. Thailand is this crucial nexus in Southeast Asia, right? You've got millions of people relying on remittances, either coming in or being sent out. And the performance of XRP there is directly tied to Ripple's massive, really aggressive strategic expansion in the Asia-Pacific region.
Okay.
This is basically the perfect environment for Ripple's flagship service, on-demand liquidity, or ODL, to prove its model actually works at scale.
Okay, let's make sure we unpack ODL a bit for everyone listening, because the mechanics are actually pretty crucial to understanding why there's specific demand for XRP.
Yeah.
So traditional cross-border payments, they usually rely on something called correspondent banking.
That's right, which basically means banks have to pre-fund accounts in the destination country. These are called Nostro and Vostro accounts with the local fiat currency.
Right, so they have to park money there in advance.
Right. Exactly, and that's the key friction point. Pre-funding these accounts, it locks up capital, sometimes for days, and it requires significant operational overhead, especially if you're dealing with less liquid currencies. This slows transfers down, increases costs dramatically. It's inefficient.
Okay, so how does ODL fix that using XRP?
Well, ODL uses the XRP ledger to instantly source liquidity. XRP acts as a bridge currency.
The bridge, okay.
Yeah. So imagine a payment provider in Thailand needs to send Thai baht, THB, to, let's say, the Philippines, in Philippine peso, PHP. They initiate the payment. They convert THB to XRP instantaneously. That XRP is then sent across the ledger super fast to the destination country. And there, it's instantly converted from XRP into PHP for the final recipient.
Okay, so it's fiat to XRP, then XRP back to fiat, all really fast.
In near seconds, typically, rather than days. And crucially, it eliminates the need for those pre-funded Nostro accounts.
Freeing up capital.
Yeah. Exactly. Frees up capital, drastically reduces costs. And this efficiency advantage over the legacy SWIFT system, particularly in these high-volume, low-margin markets like the Southeast Asian remittance corridor, that's the real driver of XRP demand.
So when we see volume increasing in Thailand,
it indicates financial institutions, payment providers, they're actually using these services, and they need XRP to facilitate every single one of those transactions.
But wait, someone listening might ask, okay, why XRP over, say, modern stablecoins? We hear a lot about USDT being used for speed and regional payments, too. What makes ODL and XRP maybe uniquely effective for remittances specifically?
That's an excellent point, and it gets deeper into the analysis. So while stablecoins like USDT offer speed, they often still require the sender or receiver to actually hold a stablecoin wallet.
Right. Not everyone has one.
Exactly. And they sometimes face higher regulatory scrutiny depending on the jurisdiction. ODL is designed to be, well, almost invisible to the end user. It integrates directly with established regulated financial institutions. Plus, because XRP is the native decentralized bridge asset on its ledger, it can potentially offer deeper, faster liquidity than maybe a centralized stablecoin that's operating across a complex web of regional exchanges.
So its success in Thailand is really about regulatory acceptance within the existing financial system.
Fundamentally, yes. Which brings us squarely to that regulatory factor. This success hinges entirely on the local environment. while Ripple spent years, locked in complex litigation in the U.S. debating XRP's status.
Yeah, it's the whole security thing.
Right. Southeast Asia, and Thailand specifically, was actually emerging as this supportive testing ground. Local regulators there have shown a willingness to classify XRP primarily as a digital asset for payment facilitation.
Not as an investment contract.
Exactly, which fundamentally de-risks its use for institutions. That regulatory clarity is huge.
You really can't overstate that, can you?
No, you can't. When a major local Thai bank or payment provider partners with Ripple, they're doing it with confidence that the government isn't going to just suddenly shut down their remittance rail overnight. And that institutional confidence is what fundamentally drives asset performance outside the typical Western regulatory anxieties that so often suppress price action elsewhere.
Okay, this is where we should look at the data points traders use to actually prove this thesis, right? Analysts assessing true organic demand, they aren't just relying on the global XRP-USD pair, which can be noisy, full of speculation.
A bit easily manipulated.
They're digging specifically into the XRP-THB trading volume, the volume traded directly against the Thai baht.
Exactly. That is the crucial analytic proxy. If the XRP-THB volume is rising disproportionately, so for example, if XRP's volume against the baht is up, say, 50% in a month, but its volume against the US dollar is only up 10%. That proves Thailand is playing an outsized role in generating genuine demand and liquidity for the asset. It signifies organic, non-arbitrage demand.
Meaning actual payment providers using ODL.
Correct. Which is far more bullish, far more sustainable than just global retail speculation. It suggests this deep, localized confidence, kind of independent of what people in America or Europe might be thinking.
And we should connect this demand back to the broader liquidity structure in Asia, too. You mentioned stablecoins.
Yeah, absolutely. As our sources noted, the dominance of stablecoins, particularly USDT, in Asia, especially China and Southeast Asia, it helps anchor global liquidity. It provides these massive liquid trading pairs needed for efficient currency conversion in the background.
Right.
XRP is successfully slotting directly into these existing high-volume Asian financial flows. It's leveraging that depth of capital to ensure ODL operates smoothly.
So if we connect this to the bigger picture, what does this Southeast Asian data really tell us?
Well, driven by demonstrable cost reduction and efficiency gains, it's a really powerful indicator. It doesn't just show that XRP works in Thailand, it foreshadows global adoption trends for payment-focused digital assets more broadly.
It's like a blueprint.
Exactly, it provides a blueprint. Once regulatory clarity follows in other major jurisdictions, maybe Europe or eventually even the US, we have actual evidence that this remittance model, facilitated by these kinds of digital assets, works efficiently at scale.
Okay, so a very clear success story, rooted in utility, regulatory alignment, regional economic need. Makes sense. Now, though, we have to pivot to the sharp opposite. The acute challenges facing an infrastructure utility token, Filecoin, specifically in the major trading hub of Shanghai.
Yeah. And this transition is absolutely essential because we're moving from success driven by external demand for payment efficiency, like with XRP,
Right.
to a major struggle facing an infrastructure utility token, Filecoin, FIL, whose entire value proposition is tied to the future fulfillment of internal demand for decentralized storage.
And the reports coming out of Shanghai regarding FIL, they've been unequivocally negative lately. We're seeing heavy, concentrated selling pressure.
Yeah, quite significant.
So the key for investors, I guess, is understanding not just that traders are selling, but the structural reasons why Shanghai investors, who historically have been pretty major participants in these big infrastructure projects, why are they dumping FI now?
Well, our analysis points to three critical drivers sort of converging here. The first, and probably the most foundational, is this growing concern over sustainable storage demand. Filecoin's economic model, it requires individuals and companies to actually pay for and use its decentralized storage capacity. That's the whole point. If the rate of real adoption, but clients actually paying to store their data is slow or stagnant, then the utility token loses its foundational value proposition. Its purpose isn't being fulfilled.
Which means the supply side might be fundamentally flawed relative to that demand. Like the miners or storage providers in Filecoin's case.
Right, storage providers.
They're incentivized to stake FIL, provide massive amounts of theoretical storage capacity, hoping to earn block rewards.
Yep.
But if that capacity is just vastly outstripping the actual real-world demand from clients who need to store data, you get this efficiency mismatch. The supply of staked tokens just dwarfs the utility demand.
Precisely. It creates more of a speculative loop rather than a truly economic one. Which leads to the second major driver, and this is highly localized, really critical to Asian market analysis, the impact of scheduled token unlocks.
Ah, the unlocks, always a factor.
Always. Filecoin, like many of these large infrastructure tokens, distributed huge volumes of tokens early on to its storage providers, early institutional backers, development teams. And these tokens are often subject to preset release schedules, vesting over years.
And when a big chunk of those tokens unlocks and becomes liquid all at once, massive supply shock.
A sudden, concentrated supply shock. And if the underlying demand for storage utility isn't robust enough to absorb that new volume hitting the market.
The only outcome is heavy selling pressure.
Pretty much. And we're seeing reports indicating that Shanghai-based storage providers and maybe some early Asian institutional holders facing the pressure of these unlocks, perhaps needing to re-optimize their capital, are responsible for a significant chunk of this concentrated market liquidation.
Okay, and the third factor you mentioned.
Yeah, the third factor seems to be a perceived shifting investor focus. This isn't necessarily just about FIL's technology itself. It might be a broader critique of the massive sort of centralized infrastructure Web3 model.
Interesting.
The attention, the capital, might be moving away from these big utility tokens tied to things like storage and maybe toward more agile application layer projects or perhaps layer 2 solutions that seem to have more immediate, tangible utility.
So this shift forces us to ask a pretty important question then. Is the storage token model itself, is it inherently broken? Or is this just temporary volatility for Filecoin?
That's exactly the debate the market is having right now. Is staking tokens for infrastructure, where providers are essentially being paid to wait for users, is that a sustainable, long-term economic loop without immediate, robust external demand?
Yeah.
The Shanghai sell-off strongly suggests a profound lack of faith, or at least a real impatience, regarding that short to medium-term utility fulfillment. They seem to be signaling that the waiting period is just no longer acceptable, especially given the dilution coming from the unlocks.
Okay, so how do analysts actually confirm this is Shanghai-centric selling and not just, the whole crypto market dipping? What are the technical tracking mechanisms?
Right, good question. This is done through really granular analysis of trading patterns. Analysts will specifically monitor the FIL price chart, looking for dramatic volume spikes that occur during peak Asian trading hours.
Which typically correlate with the business day in Shanghai.
Exactly. So if the price drops dramatically during those specific hours, and that drop correlates with massive net outflows or unusually high sell-side volume coming from exchanges known to be highly popular in mainland China and the surrounding regions,
That you can pinpoint it.
then analysts can confidently pinpoint where the sell-offs are concentrated. It stops being just a general global macro correction and becomes a much more localized response, likely tied to those tokenomics and maybe policy perception issues we talked about.
And to provide maybe deeper context here, we should bring in that historical parallel you mentioned. This isn't the first time that swift policy or sentiment shifts in China have caused these massive, concentrated, market-moving pressures globally.
Absolutely not. The benchmark example, the one everyone remembers, is the 2021 Chinese government crackdown on crypto mining.
Yeah, that was huge.
It was immediate and brutal. Overnight, we saw the global Bitcoin hash rate plummet by nearly 50%. Millions, maybe billions of dollars worth of mining equipment had to be liquidated or rapidly relocated. Miners, primarily based in places like Sichuan and Inner Mongolia, were just forced to rapidly sell off their newly mined assets, sell their equipment, just to cover operational and relocation costs. It was chaos.
And that massive, concentrated liquidation caused profound market moves globally, even though the policy itself was technically localized to China.
Exactly. And the FIL sell-off, while obviously much smaller in scale, it echoes that same pattern. Swift policy changes, shifts in utility perception, or even just sudden confidence issues within large Chinese trading circles. They have a demonstrated localized ability to trigger massive, concentrated volatility that absolutely ripples outward to the rest of the crypto world.
So the challenge here isn't just about Filecoin's tech, is it?
No, it's about concentrated regional retail and institutional reactions to token supply, to utility fulfillment deadlines, and of course the always unpredictable regulatory environment in mainland China.
Okay, so let's try to synthesize this a bit. What does this deep knowledge about these hyper-regional flows, the XRP success in Thailand versus the FIL struggle in Shanghai, what does it really mean for you, the global learner? How do we use this divergence to make maybe better investment or analytical decisions?
Well, the first and I think most crucial lesson, regardless of where you're based geographically, is about the inherent danger of regional concentration. Whether it's retail or institutional, our sources rightly highlighted the Terra Luna collapse back in 2022 as this powerful, really necessary cautionary tale.
Hmm.
While LNA was technically a global project, its retail base and even its institutional base was heavily concentrated in specific Asian markets,
Yeah.
particularly Korea.
So when the collapse started,
That high concentration of similar retail investors, all subject to the same local news cycles, the same trading platform narrative, often facing the same margin calls from the same lenders, it just amplified the market volatility exponentially.
it's like a risk multiplier effect.
Right. Exactly. When a large concentrated percentage of an asset's holders are all subject to the same local policies or the same synchronized event like a big token unlock or even just the same local media narrative, the market reaction is almost always far more violent and less predictable than if that holder base were globally diverse and subject to lots of different narratives.
So you need to actively seek diversification, not just of asset class, but maybe diversification of the regional holder base within an asset.
That's a really good way to put it, yes.
Okay. This analysis also forces us to categorize these assets much more rigorously, doesn't it? The stark contrast between XRP's success and FIL's struggle makes this categorization pretty clear. Payment-focused assets, like XRP, seem fundamentally driven by external factors.
Right. Regulatory clarity, demonstrable cost savings, verifiable remittance use cases. Their success is external, really relying on the global financial system integrating them seamlessly or at least allowing them to operate.
Whereas infrastructure and utility assets, like FIL, they seem driven by long-term internal adoption.
Exactly. Their valuation is intensely tied to internal forces, specifically the health of their tokenomics, which means these big concerns over whether scheduled unlocks can actually be absorbed by genuine demand for the utility fulfillment.
And if that utility just doesn't materialize on the expected timeline.
Or if the economic model is maybe fundamentally front-loaded with rewards just for providing capacity, then the tokenomics themselves become an immediate liability, regardless of how good the underlying technology might actually be.
Okay. And this brings us back to that concept of foreshadowing, which feels like the final big implication we need to consider. We need to revisit that idea that Asia market flows, historically, often foreshadow global adoption trends or maybe major market shifts.
Absolutely.
Yeah.
Just think about it logically. The Asia-Pacific region represents the world's largest and fastest-growing financial market by many measures. So if Ripple can prove ODL utility at scale there, demonstrating real-world institutional-grade efficiency in that massive remittance market, it's not some fringe event.
It's a field-tested blueprint.
Exactly. It's a blueprint that will inevitably, you'd think, be adopted either by competitors or eventually acknowledged by regulatory bodies elsewhere.
Conversely.
Conversely, if concentrated selling pressure in Shanghai accurately highlights a deep, maybe unresolvable flaw in a utility token's incentive structure or its supply model, that skepticism will also inevitably spread. It'll reach Western investors who are often, frankly, a bit slower to react to the nitty-gritty details of tokenomics.
So the immediate practical question for global traders isn't just if they should be watching regional narratives when trading altcoins, but maybe how deeply they need to be tracking things like localized trading volume pairs like XRP THB or exchange flow data concentrated during specific Asian trading hours.
It sounds like the answer is yes, it's a definitive necessity,
Yeah.
especially for risk management. It's entirely necessary now, I'd argue. If you are only looking at XRP USD, you are missing the signal that institutional utility demand showing up in XRP THB. If you are only viewing Filecoin through the lens of maybe optimistic U.S. venture capital funding announcements from years ago, you are missing the real-time concentrated feedback loop from these large, active Asian trading communities.
Who are reacting to fundamental economic pressures like supply unlocks and utility deficits.
Exactly. Ignoring regional nuance in today's deeply connected, yet still very fragmented crypto world, it just means you're operating with a potentially dangerous information lag.
This shift is really about recognizing where the real volume is, where the deep liquidity is actually established. It's moving away from maybe purely speculative Western narratives towards these utility-driven, high-volume Asian corridors, which seem to be becoming the true anchors for many crypto assets outside of, Bitcoin and Ethereum. #tag outro. Wow, okay. This has been an incredibly detailed and I think really necessary deep dive today. The crucial learning point, it seems, is that understanding global crypto markets requires actively zooming into these regional nuances. You simply cannot trade or analyze the altcoin market effectively by just treating it as one single homogeneous entity driven only by global headlines.
Yeah, that's well put.
The institutional optimism and the utility being fueled by ODL in Thailand, that's every bit as important to the global market health, it seems, as the concentrated selling pressure being driven by token utility concerns and supply shocks over in Shanghai.
Definitely. And we've established that Asian market liquidity, driven by massive commerce, huge remittance volumes, is already a primary global anchor. We see that exemplified by the overwhelming dominance of stablecoins like USDT in the region. And this dynamic, it leads us nicely into our final provocative thought for you to consider as you wrap up listening to this deep dive. Given the increasing evidence, the data points showing this powerful influence of Asian liquidity, and I mean real transactional liquidity, driven by financial commerce and localized utility adoption, how much longer can Western regulatory narratives, which are often focused on legacy financial systems and, decades-old securities law, how much longer can they truly maintain dominance?
Especially when real-world traction and major volume shifts are occurring increasingly and perhaps overwhelmingly in the Asia-Pacific region.
Exactly. Is this a fundamental, maybe even irreversible geographical shift of power in crypto adoption? It certainly demands constant attention from the global investor, I think.
The truly powerful thought to wrap things up on. We definitely encourage you to continue your own exploration of these regional dynamics. Maybe look into some of the specific analytical data sets we discussed today. Thank you so much for joining us for this deep dive.
Thanks, everyone.
We'll see you next time.